Hello, I'm Flick Fornia, a consulting actuary of Pension Trustee Advisors and on the board Smart Faculty, and I'm the author of this talk on expected rate of return on public pension plan assets. We're very pleased to have Rick Reed, Chief Actuary for the California State Teacher Retirement System, that's CalSTRS, with us today to discuss expected rate of return with a focus on CalSTRS. Rick is a fellow of the Conference of Consulting Actuaries, an associate of the Society of Actuaries, a member of the American Academy of Actuaries, and an enrolled actuary. Rick, hello. You've been the actuary for CalSTRS for 20 years now, after a few years at CalPERS, and previously where I first met you in the early 1980s at Milliman. Thank you so much for joining us with this interview. You and I have been involved in setting the expected rate of investment return for our clients for many years. And you were telling me about the rigorous approach that CalSTRS undertakes every 4 years to develop its expected rate of return. Can you please give us an overview of the CalSTRS process?
Yes, thanks, Flick, very much. Yes, the CalSTRS process occurs every 4 years. We set our investment return assumption. It begins with a multi-step process, and it takes well over a year. And it starts with, first, the investment piece, and the board sets the asset allocation. And so in January, we'll begin an asset allocation process with the board where we establish returns by asset class. And so there are the various asset classes: bonds, stocks, plus others, private equity, and then we have some called risk mitigation. We have investment overall, we have inflation sensitive, so we have a number of asset classes. So it starts there, and that process takes most of the year. And so there are 6 meetings in which we're involved with asset allocation. So in January, in March, and in May, July, September, and finally November. And so as the board discusses asset allocation, the actuaries are collaborating with an investment group to present to the board the results of any asset allocation that the board might choose. So the board goes through this process where they look at various asset allocations and the effect on the portfolio. And then they ask actuaries, we're doing calculations to determine the effect on contributions, the fund, benefits, etc. So around August, the actuaries begin the experience study, keeping in mind the discussions that the board is taking on asset allocation.
So let me ask you a question on that. So on asset
Sure.
Allocation, in the talk that many of the viewers have just seen, I didn't go into how the investment return varies by asset class, but can you explain why the asset allocation, what the linkage is between the asset allocation and what the expected return would be?
Yeah. So in any portfolio that as big as ours, we have various different asset classes, meaning we invest in different categories of stocks. We have general stocks. We actually have global equity outside of US equity, those are stocks. Then we have bonds. We have private equity. We have different classes like risk mitigation, where we invest in things that are expected to do better in a down market and things that are expected to do better in an inflation market. And so each of those different asset allocations have an expected rate of return. So we expect to make so much per year off of the different asset allocations. We have real estate in there. We have different types of real estate assets also. So depending on where we put our money in each of those classes, it changes what we expect the overall fund to earn. So if we put more into the high yielding asset classes, we expect to earn more. But there's a price. There's also a greater risk that we don't do well. So there's a negative risk that we have big losses in some of the more risky asset classes. And so you have to weight risk versus return. So in any asset class, there's a risk and there's an expected return. And so generally, the higher the risk, the higher the return. The lower the return, the lower the risk. So there's a balance there, and that's what gets discussed during the year before the board actually decides which asset allocation that they want to choose for the fund.
Okay, and that's where some of the projections come in, so they have a good understanding of that risk reward trade-off.
Yes, and so depending on where they want depending on the asset allocation, that means a different expected return for the overall portfolio, and it also changes our calculations of what the overall liability to the fund is. So depending on which asset allocation that the board chooses, we'll give them what we think the results are, and we also give them a hint of where our assumptions are going to be. So for a particular asset allocation, the expected might be 7.5, but with higher risk, and we'll tell them where that leads us, or it can be 6.5 with very, very low risk, and we'll tell them that too. So they'll know where we're going for each asset allocation.
Got it, thanks.
Okay, so after that, when the board chooses an asset allocation, usually in September, then we'll come back in November all together with the investment staff, and we'll tell them the results of each of those portfolios. And then finally, the board in November will choose a particular asset allocation for the fund, and they'll choose also the ranges of investment. So they might want to invest 40% in US equities and 20% in foreign equities, or they might want to invest 5% in risk mitigation. They might want their private equity fund to be, between 10 and 15%. So all of those get voted on and approved by the board, usually in November. Meanwhile, we're working on our experience study, and in February of the next year, we will present the results of the experience study to the board, including our recommendation for an investment return assumption. And so that's where that discussion occurs, usually in the board meeting after the asset allocation study is completed and after the board has chosen a particular asset allocation for the fund.
So you actuaries need to know what the asset allocation is going to be in order to come up with your estimates of the expected rate of return.
Right.
And
so,
go ahead.
Yeah, correct.
And then the investment consultants, they kind of weigh in on these, on their assumed rates of return by asset class also, right? So you need to kind of work together. Is that the way it works?
That's the way it works. And because there's a little bit of difference between their view and our view, time-wise, meaning this, the investment consultants usually will give what they think the expected rate of return for the fund is over a 10 or 20-year period. And our assumptions are basically over a 30-year period where we think the fund's going to be. And so we have to actually work through their recommendations and what our recommendations are. So they may say the fund will earn 7.5 over 20 years, but now we need to give a recommendation of what we think the fund will go over 30 years. And so that's where we work with the investment consultants to kind of work through that. We also have, based on our asset allocation, plus now we have to consider the inflation expectation over the next 30 years. And so investment consultants may say over the next 10 years, we expect 2.5. But now we've got to make sure that we get something that will work for 30 years, and whether that's higher or lower. And so we're also going to work with them as they say, well, they may say this is what we expect over 10 years, but we think over the long term, inflation will return more to historical levels. Which
Okay,
means,
so that is that why often the investment consultants have lower inflation assumptions that we actuaries do, and therefore they would have lower nominal return assumptions than we do?
right, because the expected return recommendation will be sort of the normal return plus inflation expectations. And so if we add those two together, then we'll get what we will recommend. And because the inflation recommendation assumption is different because there are different time periods involved, oftentimes we'll come up with a different recommendation than what the investment consultant may say they expect over 10 or 20-year period. Because now we're talking about a 30-year period and we have a different inflation assumption.
Well, that kind of brings you to my next question: is who has the ultimate authority in setting these assumptions in your case?
So the board. So what happens is in February, after the asset allocation study is done, and after we've collaborated with the investment consultants and made the inflation recommendations, then we'll bring all of that to the board in the experience study, the recommendation for the investment return. So the board will review the experience study, and then they will vote to accept generally the entire experience study. Now sometimes they can separate different assumptions and vote on those separately, but generally they'll accept once it's discussed, the entire experience study, which includes those recommendations. And so that's what happened the last time. Yeah.
Okay, and we have an actual standard of practice, of course, that we need to abide by, which is if we as actuaries don't believe the assumptions are reasonable, we have to disclose that in our reports. So the board generally does work together with us and come up with assumptions that we agree on.
Yeah, and in our case, if it hasn't happened, but if the investment consultants were in the entire process recommending something we think is unreasonable, we would have stated that long before that, and the board would know long before February that what the investment consultants are recommending we don't find reasonable. So we don't even wait till we get to the report to put that in there. So that's long communicated. And part of the process is to make sure that everybody's on the same page with the investment consultant. That's one reason why it takes entire year. And along the way, not only are we talking about asset allocation, we're also talking about inflation assumptions too. So by the time we get to February, everybody's on board with what the recommendations are going to be. So it's a surprise.
So where are you right now? You're just moving to 7%, or I forget.
So we just completed the experience study this past February, and the asset allocation was the entire year before that. So 2019 was the asset allocation study. We completed the experience study and presented to the board in February. So we moved to, we were at 7%. So we stayed at 7%. I think the last time we had moved down to 7%, but prior to that, we were at 7.5. So we've gone from 7.5 to 7 within the last 3 years.
Okay. And Rick, the recent California pension reform, I forget the name of it, but that actually requires that for some of your members, their contributions change if your investment return assumptions change. How does that work?
So yeah, so based on pension reform, which occurred a number of years ago, so the members in tier, I don't call it 2% at 62 group, pay half of the normal cost. So anytime the normal cost changes by more than 1%, that changes the member contributions. So if the normal cost, something called a normal cost, which is for viewers, is the actuary's estimate of the annual cost of the plan. If that changes by more than 1% of pay, then members contributions in this group would increase or decrease by 0.5%. So for example, if the normal cost changed by 1%, which it did, then the members would contribute an additional 0.5% of pay. And so that may be a consideration in the assumptions that we're looking at, but it doesn't shape it. So we're going to recommend what we think is correct, and then the other things will happen. So we went down to 7%. That caused more than a 1% increase in the normal cost. And so members would contribute an additional 0.5 of 1% of pay to the pension plan.
Got it. Because normal cost is the cost of the ongoing pension. And if you're assuming you're going to earn less, then the cost is going to be higher than if you assume you're going to earn more.
Right. So we're assuming the fund's going to earn less than what we had previously stated.
Okay. And also, I want to mention, you're at 7%. That's a little lower than the average right now, I believe. I think NASRA had the average at 7.18 or something like that.
Yes, and we were aware of that. All of that was discussed. The board wanted to put a little bit of risk mitigation into it. And so they realized that that was a little bit lower. It was also lower than our average expectation. And so we were a little bit lower than that also. So we put in a little margin for what we call, actuaries call adverse deviation. So just a risk, just a cushion, basically, on that. So yes, we were a little bit lower than what others are using.
Got it. Well, Rick, before we wrap up, is there anything else you think we should know on the CalSTRS process for setting investment return assumptions?
Yeah, it's very dynamic. So the meetings actually help determine the asset allocation. I mean, and there's robust discussion. And you just mentioned that we were lower than what the average was, and we were lower than what our expectation was based on the asset allocation groups. That was a result of the process. And so the discussion occurred, and then there became a desire on some of the board members to put a cushion in what we thought we could get and what we were going to base our contributions and liabilities on. So the process is very dynamic, and as long as you can keep that and keep the collaboration and investment return, I think you can produce something that's very reasonable that'll work. So, and we'll do it so we'll do it again another 4 years.
Excellent. Hey, well, thank you very much, Rick. This has been a pleasure to see you again.
Sure.
And thanks so much for providing your time educating trustees on this important issue. I really look forward to seeing you again one of these days in person. Thank you.
I look forward to seeing a lot of people in person again. So.
Thanks, Rick.